the cold, dark waters of the North Atlantic on April 15, 1912, the RMS Titanic, a monument to human ingenuity and industrial progress, slipped beneath the waves, taking with it over 1,500 souls. 17 months later, on December 23, 1913, President Woodrow Wilson signed the Federal Reserve Act, forever changing America's financial landscape. Two seemingly unrelated events, separated by ocean and purpose, yet connected in the shadows of conspiracy theories that have persisted for over a century. Today we embark on a journey through one of history's most persistent conspiracy narratives, the alleged plot to sink the Titanic to eliminate opposition to the Federal Reserve's creation. As we navigate these murky waters, we'll separate historical fact from speculative fiction, examining why such theories emerge, what truths they might contain, and what they reveal about our relationship with power, money, and catastrophe. The early 20th century witnessed humanity's romance with technological prowess. The White Star Line's RMS Titanic stood as the crowning achievement of this era, a floating palace of luxury and engineering marvel. At 882 feet long and weighing 46,328 tons, she was the largest moving object ever built by human hands. Not even God himself could sink this ship, an employee reportedly boasted. Such hubris seems almost to invite tragedy in retrospect. The Titanic was more than a vessel. It was a floating microcosm of the Edwardian social hierarchy. The first-class passengers represented the elite of society: industrialists, bankers, politicians. Among them were some of the world's wealthiest men: John Jacob Astor IV, Benjamin Guggenheim, and Isidor Straus. Their combined wealth would be equivalent to billions in today's currency. On April 14, 1912, despite receiving ice warnings throughout the day, Captain Edward Smith maintained the ship's speed of 22 knots. At 11:40 p.m., lookout Frederick Fleet spotted an iceberg dead ahead. Despite efforts to avoid collision, the starboard side of the Titanic scraped against the iceberg, creating a series of fatal gashes below the waterline. 2 hours and 40 minutes later, the unsinkable ship broke apart and disappeared beneath the freezing waters. Of the 2,224 passengers and crew aboard, only 706 survived, making it one of the deadliest peacetime maritime disasters in history. The official investigations, conducted by both American and British authorities, concluded that excessive speed, inadequate lifeboat capacity, and failure to heed ice warnings caused the disaster. Yet alternative explanations began almost immediately. To understand the creation of the Federal Reserve, we must first comprehend the financial chaos that preceded it. The American economy of the early 20th century was plagued by recurring financial panics. The Panic of 1907 proved particularly devastating. When the Knickerbocker Trust Company collapsed, it triggered a run on banks that spread like wildfire. The crisis was eventually stemmed only through the intervention of financier J.P. Morgan, who organized a coalition of bankers to inject liquidity into the market. The 1907 crisis exposed a fundamental weakness in America's financial architecture. Unlike European nations, the United States lacked a central bank to serve as a lender of last resort during financial emergencies. This vulnerability left the nation's economic stability dependent on the goodwill and resources of private bankers like Morgan. In November 1910, a clandestine gathering occurred that would later fuel countless conspiracy theories. Senator Nelson Aldrich, Assistant Secretary of the Treasury A. Piatt Andrew, and 5 leading bankers, including representatives from the houses of Morgan and Rockefeller, met in absolute secrecy at Jekyll Island, Georgia. The participants traveled under assumed names, using only first names during their discussions. The meeting's existence remained secret for years. Even the staff at the exclusive Jekyll Island Club believed they were hosting a duck hunting expedition rather than a meeting that would reshape America's financial system. During this retreat, the group drafted the Aldrich Plan, the blueprint for what would eventually become the Federal Reserve System. This secretive genesis would later provide fertile ground for conspiracy theories. After years of debate and revision, President Woodrow Wilson signed the Federal Reserve Act on December 23, 1913. The legislation established a decentralized central bank with 12 regional Federal Reserve banks operating under the oversight of a Federal Reserve Board. The Fed, as it came to be known, was granted authority to issue currency, serve as a lender of last resort to member banks, and implement monetary policy. It represented a compromise between those who wanted strict government control over banking and those who wished to maintain private banking power. The timing, just before Christmas, when many legislators had already left Washington, has itself fueled suspicions about the urgency to pass this landmark legislation, with minimal scrutiny. The conspiracy theory connecting the Titanic sinking to the Federal Reserve's creation typically alleges the following. Powerful bankers, including J.P. Morgan, plotted to eliminate wealthy industrialists who opposed the creation of a central bank. These opponents, allegedly including John Jacob Astor IV, Benjamin Guggenheim, and Isidor Straus, were deliberately gathered on the Titanic. J.P. Morgan was supposed to be on the ship but canceled at the last minute. The Titanic was switched with its damaged sister ship, the Olympic, as part of an insurance fraud scheme. The ship was deliberately steered into iceberg territory despite warnings. With key opponents dead, the Federal Reserve Act passed with minimal resistance. This narrative combines elements of actual historical events with speculative connections, creating a seemingly cohesive alternative history. Let's analyze these claims against historical records. Claim: J.P. Morgan owned the White Star Line and canceled his trip at the last minute. Fact: Morgan did own the International Mercantile Marine Company, which controlled White Star Line. He did cancel his passage on the Titanic, citing health reasons. However, Morgan was 75 years old with deteriorating health and died less than a year later. His cancellation came several days before sailing, not last minute as often claimed. Claim: Astor, Guggenheim, and Straus were vocal opponents of the Federal Reserve. Fact: while these men were certainly powerful and influential, historical records do not indicate they were organized or vocal opponents of central banking reform. Their political activities were varied and complex. Astor, for instance, had diverse business interests beyond banking. Historical documents, including congressional records from banking committee hearings, do not show them testifying against the Federal Reserve concept. Claim: the Titanic was actually the Olympic, damaged in an earlier collision and switched for insurance purposes. Fact: while both ships were similar, they had numerous structural differences that would have made such a switch impossible to hide from the thousands of workers at Harland and Wolff shipyard. Additionally, the Olympic continued sailing for many years after the Titanic disaster, serving as a troop transport in World War I and operating as a passenger liner until 1935. Claim: the ship was deliberately steered into danger. Fact: Captain Smith's decision to maintain speed despite ice warnings reflects the standard maritime practice of the era. Ships typically relied on being able to spot icebergs in time to avoid them. The fatal error was one of overconfidence in existing procedures, not a deliberate act of sabotage. Claim: the Federal Reserve Act passed only after these opponents were eliminated. Fact: the legislative battle over banking reform was complex and extended over several years. The initial Aldrich Plan faced significant opposition and underwent substantial revisions before becoming the Federal Reserve Act. The political obstacles were more ideological and institutional than personal. One significant issue with the conspiracy theory is the timeline. The Titanic sank in April 1912, while the Federal Reserve Act wasn't signed until December 1913, more than 19 months later. If the sinking was meant to eliminate opposition to allow quick passage of the legislation, the lengthy delay makes little tactical sense. Furthermore, the Federal Reserve Act that eventually passed differed significantly from the original Aldrich Plan. If powerful bankers controlled events to the extent of orchestrating a major maritime disaster, why would they accept a compromised version of their original plan? Human minds naturally seek patterns and meaning, especially in catastrophic events. The random sinking of the world's most advanced ship challenges our sense of order. Conspiracy theories offer a narrative where such disasters happen for reasons, not by chance or human error. As historian Richard Hofstadter noted in his essay, The Paranoid Style in American Politics, conspiracy theories provide the satisfaction of having discovered the truth hidden from others. They transform random tragedy into meaningful narrative. The early 20th century marked the peak of the Gilded Age's inequality. Figures like Morgan, Rockefeller, and Carnegie controlled unprecedented wealth and power. The secretive Jekyll Island meeting confirmed public suspicions about how the elite operated behind closed doors. The Federal Reserve's creation did indeed represent a significant concentration of financial power. While designed with checks and balances, its influence over monetary policy granted immense authority to a small group of individuals. This legitimate concern about power concentration provides fertile ground for more extreme theories. Conspiracy narratives offer what mainstream history often cannot: a sense of uncovering hidden truth. They position the believer as more perceptive than conventional historians, seeing connections others miss. These narratives also simplify complex historical processes. Rather than understanding the Federal Reserve's creation as the product of competing interests, institutional evolution, and incremental policy development, conspiracy theories reduce it to a single, dramatic plot. While the Titanic Federal Reserve conspiracy theory lacks credible evidence, legitimate questions surround the Federal Reserve's creation and operation. The Jekyll Island meeting was genuinely secretive, designed to shield the participants from public and political scrutiny while they drafted transformative legislation. Banking reform advocate Louis Brandeis warned in 1914, "We must break the money trust or the money trust will break us." His concern reflected genuine democratic anxieties about concentrating financial power in private hands, partially shielded from public accountability. The Federal Reserve embodies a fundamental tension in American governance between private and public power. The regional reserve banks are technically owned by member banks, creating a hybrid institution that is neither fully public nor private. This ambiguous structure has fueled ongoing debates about whose interests the Fed serves. During financial crises, particularly the 2008 Great Recession, critics from both left and right questioned whether the Federal Reserve prioritized Wall Street over Main Street. The Federal Reserve that emerged in 1913 differs substantially from today's institution. Major legislation in 1935, 1978, and 2010 significantly altered its powers, governance, and objectives. These changes reflect ongoing struggles to balance financial stability with democratic accountability. The real conspiracy, if we can call it that, is not a single dramatic plot, but the incremental concentration of financial authority in institutions partially insulated from democratic oversight. This process occurred in full view, through legislation and policy evolution, not through orchestrated disasters. The Titanic disaster prompted significant maritime safety reforms. The International Convention for the Safety of Life at Sea, adopted in 1914, mandated sufficient lifeboats for all passengers, 24-hour radio communications, and regular lifeboat drills. The tragedy also marked a symbolic end to the Edwardian era's technological optimism. The unsinkable ship's fate suggested limits to human mastery over nature, a theme that would be horrifically reinforced by the mechanized slaughter of World War I just 2 years later. The Federal Reserve System has evolved significantly since its controversial birth. During the Great Depression, it initially failed in its mission to prevent financial collapse. This failure led to the Banking Act of 1935, which centralized power in the Federal Reserve Board in Washington, rather than the regional banks dominated by private bankers. The Fed has since become the primary manager of America's monetary policy, employing tools unimaginable to its founders. From interest rate manipulation to quantitative easing, its influence extends throughout the global economy. During the 2008 financial crisis and the 2020 COVID-19 pandemic, the Fed assumed even broader powers, essentially functioning as the financial system's emergency backstop. These actions saved the financial system, but raised new questions about moral hazard and democratic accountability. The alleged plot linking the Titanic's sinking to the Federal Reserve's creation fails historical scrutiny. The evidence doesn't support the dramatic narrative of murdered millionaires and orchestrated maritime disasters. Yet this conspiracy theory persists because it addresses genuine concerns about power, wealth, and governance. The Federal Reserve's creation did mark a significant concentration of financial authority. The Jekyll Island meeting was genuinely secretive. Powerful bankers did influence legislation affecting millions of Americans. The true historical lesson lies not in imagined plots, but in understanding how financial power operates. sometimes in the shadows, sometimes in plain sight, rarely with the dramatic flair of conspiracy narratives, but always consequentially. The sinking of the Titanic and the birth of the Federal Reserve both remind us that human institutions, whether ships or central banks, contain hidden vulnerabilities. Both catastrophic failure and systemic reform emerge from complex interactions of human error, structural weakness, and environmental pressure. In seeking to understand these events, we should demand neither the simplistic reassurance of official narratives nor the seductive drama of conspiracy theories. History deserves our most careful, critical, and nuanced attention, especially when it concerns the forces that have shaped our present world. The real secret of history isn't found in hidden plots, but in plain sight processes: how power accumulates, how systems evolve, how tragedy prompts reform, and how we continuously navigate the tension between expertise and democracy in governing complex societies. This understanding may lack the cinematic drama of conspiracy, but it offers something more valuable: the power to engage meaningfully with the financial and political systems that continue to shape our lives over a century after both the unsinkable ship and the Federal Reserve took their place in history.